You have top 10 trades. Which one do you think might be at risk, or which one do you think pretty much stays the same?
Or are you ripping the whole thing up?
Definitely not ripping it up. I mean, of course, we'll talk about the comments over the past 24 hours. But generally, I think for 2020, resolution trades, what we call resolution trades, offer pretty good risk reward. So when I look at a lot of asset prices within the rates and FX and EM markets, a lot of stuff is still well below where it was back in May 2019 when you saw a serious escalation of the trade tensions. And in some ways, of course, we can talk about if and when we get some resolution. But I think if we do get a resolution, we're at a point in the global economic cycle where some of the lead indicators are starting to pick up, and where we're potentially at an inflection point for global growth. So if you look through our list of top 10 trade ideas, a lot of these play for sort of this pent-up demand that we saw in 2019 being released, at least to some extent, in 2020. So we like buying Aussie yen, for instance, a commodity currency. We like buying cable, resolution of Brexit potentially going into 2020. We like buying inflation break-evens across a lot of markets because inflation break-evens are very, very depressed. So generally for 2020, of course, things have changed a bit over the past couple of weeks. We do expect resolution of the main uncertainties like US-China trade, Brexit, USMCA, the new NAFTA, and all of that should lead to some recovery in global growth, at least in the first half of 2020.
But given what happened today, the trade deal, and given Donald Trump's statement that could easily do it after the election next year, that throws things seriously in doubt, doesn't it?
Well, I'm not sure. I've been saying for the past 2 to 3 weeks that we won't know that we have a phase one deal until it's done. And until it's done, you're going to get a back and forth roller coaster of comments between the US and China. And I think that's exactly what's been happening over the past couple of weeks. If you think about Trump's comments as well, naturally in a negotiation, as you get to the final stages, it's in the incentives of both the US and the Chinese to sound tougher just so that they can get a better deal. And that's what Trump seems to be doing. He's saying, I can wait until 2020. China is saying, we have no reason to concede. We're prepared for the worst. That's naturally what you would expect in a negotiation. I think there are two key things to watch for from here. One is the 15 December tariff increase. Is that delayed or not? Wilbur Ross, of course, mentioned that could be delayed if the negotiations continue. And the second thing is, do we see high-level negotiations? Right now, there have been phone calls, low-level negotiations. Do we get a headline that says, Lighthizer and Mnuchin will be visiting China to meet with Liu He, or the other way around? I think if you see a headline that high-level meeting is happening, then I'm still pretty convinced that we can get a phase one deal.
It seems like dollar China is back in play now. It keeps punching higher here and testing the limits for what the PBOC is willing to tolerate. At the same time, though, you take a look at the dollar, it's actually weakening against G10 currencies. Is that kind of divergence sustainable, do you think?
Well, definitely. To the extent that dollar CNY, I think, is a direct function of tariff escalation. We know this. We've done the math. We know if tariffs go up on 15th of December, dollar CNY needs to be a lot higher. That you can have a decoupling between what the dollar is doing against broader G10 and other major currencies and what's happening to dollar CNY. I think it's pretty clear to most investors that dollar CNY will be a function of what happens to tariffs. And in particular, this is a very important issue, whether we get rollback of tariffs. Again, a couple of weeks ago, we were talking about rollback of tariffs, which would probably mean dollar CNY needs to be well below 7, or maybe at 6.90. So again, if we get that as part of the agreement, I think it'll be quite critical.
If the tariffs are rolled back, then does the dollar overall roll over as well? Because that's good news for EM, I would imagine.
So that's a very good question. I think ultimately it does, but if you look at our trades, we don't really have an outright short dollar recommendation, with the exception of cable, which is very specifically a UK thing. And the reason I think is if you do get good news or you get a resolution, the first thing that has to happen is the Fed needs to reprice. The market is still pricing in easing for the Federal Reserve. So short-term interest rates in the US probably needs to go up, which would be associated with dollar strength. So I think the first order reaction is actually the dollar appreciates versus the low yielders, maybe not necessarily EM. And then once that happens, and once the rates market has repriced, 10-year Treasury yields are back at 2%, then you want to be selling the dollar, but not right here, right now.
If you're looking for a haven, though, what's the view on the yen?
So the yen, obviously we're bearish on the yen because the yen probably underperforms in an environment where global growth is picking up, and that probably helps the real rates in Japan to go down and sort of ultimately weakens the yen. I think there will be a limit to how weak the yen can go, because you will have local exporters coming in and buying the yen, so sort of increasing their hedge ratios. You will have, I think, institutional investors like pension funds and life insurance companies are very underhedged on their foreign investments, so they'll have an incentive to sell dollar yen if it goes well above 110. So again, I think we do think the yen underperforms, but there's probably a bit of a limit to how much it can underperform against the major currencies.
Bond markets right now, at least, in Asia in general seem to be dealing with these two conflicting forces, which is the negative trade headlines, and then it seems like it's the end, or we're getting closer to the end of this monetary easing cycle. Net, what does that mean for yields here? Are we back to a bond rally, or could things actually, this melt up in yields continue?
Yeah. So I think there still is room for some central banks to ease policy, and the most obvious one, I think, is Bank Indonesia. So we expect, at least another 50 basis points worth of cuts. Real rates are quite high. Term premium is quite high. So one of our recommended trades, which we've had for a while, actually, is to be long 10-year Indo bonds. I think that makes a lot of sense going into 2020. But of course, you're right. For other central banks where interest rates are a lot lower, there's much less room to cut rates, with the likes of, we do think Thailand and Korea will probably cut rates at least once more, but probably being long bonds there, that makes less sense relative to Indonesia.
RBA was out yesterday, arguably hawkish, pushing back on QE. Should I just ditch that idea for now?
Well, I can tell you the locals are not ditching it. The locals, will continue to talk about QE, as long as they possibly can.
For it.
Yeah, exactly right. So, and again, they took a different spin on it, which is that RBA law said 0.25% is the level at which they'll start thinking about unconventional measures. But my take is very simply, I think the RBA, to the extent possible, want to avoid unconventional measures, and they want to wait and see the lagged impact of easing, which is the sensible thing to do. Of course, they could cut rates maybe once more in 2020, but I think beyond that, unconventional measures is not part of our baseline for Australia.